Welcome, everyone. We're going to give about a minute. There should be sufficient time to enjoy our disclosure. It's so exciting when you're talking to investment people, and we have these exciting disclosures. So enjoy, and we'll be transitioning to the presentation shortly. Hopefully everyone can hear me. The title today is, Are Your Retirement Investments Supporting Racial Inequality? That might come as a shock to some, but I know that the way that the financial industry often uses things like mutual funds, it's difficult to know exactly what are you invested in. I have three wonderful guests helping me today. I guess I should say who I am for those who might be new to this. I'm James Brewer, founder and CEO of Envision Wealth Planning. I'm a certified financial planner. I hold a EMMS and MBA from MIT in management, and I'm a personal finance contributor to Forbes.com. We've got Theresa Gusman. She's First Affirmative's Chief Investment Officer. First Affirmative provides discretionary investment advisory services to investors who seek to integrate their personal values into the construction and management of their investment portfolios. Theresa's 35-plus year investment career includes being global head of equities for Deutsche Bank. She joined First Affirmative to apply her knowledge to closing the gap between intention and action in sustainable, responsible, and impact investing. And what we're going to hear about today, the values-aligned direct index solution, is the manifestation of that goal. We've also got Mike Amoroso. He's the client success manager for Your Stake. Your Stake provides advisors tools to assess how specific investments align with environmental, social, and corporate governance values. Mike's a West Point grad. Thanks for your service, Mike, and holds an MBA from Bard College in sustainable studies. While he holds the accredited portfolio management advisor and sustainable financial analyst, he's passionate about creating the change he wants to see in the world by helping members of his community redirect capital toward a shared well-being on a healthy planet. Morgan Plessix, I hope I said it right, is a senior relationship manager with Ethic. Ethic is an independent asset manager focused on delivering personalized, sustainable investing and tax-managed solutions. She previously worked at UBS Global Wealth Management in roles across the firm's major business areas, including the Sustainable Investing Solutions team. She graduated from New York University. Often that's just simply called NYU, where she studied international relations and sustainable business. So thanks to everyone who was able to join. I actually became aware that Theresa is a bit double booked today, but I think she's got some great things to tell us. So we're going to have her go a little bit out of the order of the presentation, but I think you'll see how it all will come together. So I thought I'd start us off with a little information. So, well, I did go to MIT, so maybe I got a couple of quotes from there. But Professor Lowe, who's a great finance professor and world known, said that conventional wisdom posited that investing with a purpose meant sacrificing return. A framework he developed debunks that belief. There was some more diverse team, and I think people have heard, but research has shown that diverse teams actually did increase performance. Then I became aware of this study done by As You Sow, who analyzed 1,641 US-based and publicly traded companies between 2016 and 2022. And basically it says that when there were higher percentages of non-white management, they saw increases in enterprise value and cash flow and compound annual growth rate, all things that lead to higher stock prices. Now, what a lot of people have heard when it comes to things around, let's call it diversity, equity, inclusion, or equal opportunity, tends to often lean on the advocate side. But I actually came up with this acronym. It's not Visa, the credit card, but it's VOTE, invest, spend, and advocate. So you can vote and go to the polls with your votes. You'll hear today there's another voting where you can actually take the power of the stock certificate to actually affect change in companies that you might want to see change. Then we're used to spending, and that could be boycotts. And we know about the segregation boycotts and apartheid. And currently there's some Gen Z boycotts and how that affected companies and organizations to actually make change. But at the same time, investing is available too. And that's what we're going to really focus on today. So put it all together and you got Visa. But I want to say, in these boycotts, especially the more recent ones, are they unknowingly investing in the companies that they're actually boycotting through their 401k, 403b, possibly a robo-advisor, and other types of advisors, by the way? So now to the formal agenda. I'm going to tell you a little bit about the envisioneering investment process that we use here at Envision, talk to you about third-party research, learn some really amazing things that I know that your stake delivers, and then talk about our value integrated portfolio approach where Vedas and Theresa will be speaking about, and then Morgan about ethic. And then finally, not just a lot of information, but something that you can actually take action on. So we've got several options. This slide is intended to just basically give you an idea that for, let's say, as little as $2,500 up to $500,000 plus, we have several solutions, and depending upon you and your capital access, that would determine which ones that you could use. And in some cases, you could use them all across any dollar amount. So now we're going to start with Theresa, but let me just kind of set this up a little bit. So when you work with Envision, we actually kind of have this relationship with First Affirmative, and that's who delivers the solution. Then there's the investment advisor, and we kind of work, because I'm the owner of Envision Wealth Planning, it's like the same two people. And then there's a section called, or let's say a company called custodian, and that function kind of, I liken it to a bank if you're not fully familiar, like the money's actually held there. So, we aren't taking your money like the Bernie Madoff with your money. So the money actually gets held at Charles Schwab or Apex, depending upon how much money you are investing in the Vedas solution. And then, the Vedas solution comes out of that. So now you just kind of see how all things fit together. And Theresa, are you ready? I believe you're on mute.
So, James, thank you so much for the introduction. It is my pleasure to be here today. We love working with Envision and its clients because we know that you and your clients are looking to invest in the world as you want it to be. The way that we look at this is the market reflects the world as it is today, and values aligned investors invest in the world as they want it to be and look to achieve their long-term financial and impact goals, and those are aligned with their values. So our values aligned invest direct index solution, or VEDIS, represents the future of customized portfolio management. And unlike most providers of direct index solutions, First Affirmative looked to democratize true customization. And we are providing that level of customization to clients with as little as $25,000 to invest. We can do that because we are trading fractional shares in our portfolios that are less than 250,000. So VEDIS also enables clients to invest in the world as they want it to be. It combines James's trusted personal financial advice, leading expertise in terms of research in the SRI space and portfolio management, and scalable technology. We're working directly with Your Stake, and Michael will tell you more about that for that technology. So we look to provide personalized portfolios aligned to each client's financial and impact goals. Everything we do at First Affirmative is driven by our dedication to enable clients to achieve those financial and impact objectives. And we've been doing that for more than 30 years. Next slide, please. So let's look at direct indexing. For those of you who are not familiar with direct indexing, this is a little bit of a Q&A on direct indexing. So we'll start with what is direct indexing. Direct indexing attempts to replicate the performance of an index by purchasing the underlying individual securities instead of using an ETF or a mutual fund in an investor's portfolio. So the way we look at it is an ETF or mutual fund, you kind of get what you get. You can't change up the companies in the mutual fund or the companies in the ETF. You get what you get. In a values aligned direct index solution, you get a portfolio that is specifically geared to you, designed by you, reflects your values. So values aligned direct indexes are customized and personalized based on an individual investor's financial circumstances, so the risk and return that they're looking to achieve, and their impact preferences, and can be adjusted as impact preferences or financial circumstances change. Second question, does that mean a client has to own every stock in the index? And the answer to that question is no. Using a sophisticated optimization process, we can replicate the performance of an index, custom benchmark, or model with a subset of securities and incorporate client-specific impact preferences, tax and transition considerations. And final question, is direct indexing new? And again, the answer is no. Direct indexing has been around for decades. In fact, I initially began using an early version of the optimizer we're currently using to optimize our values aligned direct indexes long ago, probably more than 20 years ago, when I was at Deutsche Bank. This is back in the 1990s, so a long time ago. But historically, direct index solutions have been reserved for ultra high net worth individuals and institutional investors. That has changed with the availability of fractional share trading and no cost or low cost custody solutions, no cost trading. So all of those things combined mean that we can offer values aligned direct index solutions to you. Next slide, please. So how is a direct index portfolio constructed? We start with an initial blended benchmark. That benchmark is comprised of 3,300 stocks. It is designed to sort of mirror the performance of the MSCI ACWI index. So you can consider our benchmark the MSCI ACWI. It's not directly aligned because any international securities are US listed in non-US companies, or they are American Depository Receipts, ADRs. So that's the initial blended benchmark. That benchmark is then adjusted for the client's personal preferences. So a client can come to us and say, I am involved in racial equity, or I am involved in environmental issues or diversity or faith-based investing. They can come to us and say, these are the things I care about. And James will work with you to identify precisely what those things are. Once we have a list of those impact preferences, the investment universe is reduced by the stocks you don't want to own and increased by the stocks you do. So you can have positive and negative preferences reflected in your portfolio. We then take the remaining stocks, and in this case, it was 2,600 stocks. So many stocks were actually removed from the universe. And then we build a direct index solution using a sophisticated optimization process, and you end up with a portfolio that is comprised of 229 stocks. So that's what the portfolio construction process looks like. I mean, obviously, we can go into lots of detail on that, but that's the high-level portfolio construction process. Next slide, please. So these are some of the custom value sets that are built into the Your Stake platform. And you can use these value sets or go through, take a questionnaire, and build a custom value set for yourself. And importantly, you can combine these various value sets, and that will build your personal portfolio as well. So obviously today's discussion is geared toward that racial equity advocate, but there are many other value sets that you can choose from. Next slide, please. Once we build the portfolio, we will demonstrate that the portfolio is aligned with your impact objectives. So the answer to the question, will Vedas meet your impact objectives, is absolutely. That's the way it is geared. And here you can see that this portfolio is better than the benchmark in the health category, in the environmental category, and in equal opportunity. Those were the broad values that were most important to this particular client. And this chart was drawn from a Your Stake report, which would be delivered to you prior to your investment. Next slide, please. The other thing that First Affirmative does, we deliver a financial report to James, which he will share to you, to demonstrate that the portfolio, in addition to allowing you to achieve your impact objectives, will allow you to achieve, or is designed to allow you to achieve, your financial objectives. And he'll talk more about that. And we can also talk about that in more one-on-one discussions. The other thing that First Affirmative does that sets us apart is we focus on advocacy and impact. We view proxy voting and advocacy work as the impact of ownership. So the tools for active ownership include proxy voting. We have our own proxy voting guidelines. These are not the guidelines that are supplied by ISS or anyone else. We're in the process of reviewing our guidelines for 2024 now, and our proxies are voted according to those guidelines. We look at the results of our voting, and I'll show you some of those by environmental, social, and governance subcategories. And we allow you to leverage proxy voting in your values aligned direct index portfolio. So our proxy voting, we voted 2,500 meetings, 2,600 proposals, 26,000 proposals. We supported many shareholder proposals. We opposed many management proposals. And that sets us apart from other organizations that are voting proxies. So if you could go to the next slide, James. This chart shows First Affirmative's support for various issues versus the average voter on each of these issues. And as you can see, we did not support every person for their board seats. We did not support management compensation in many instances, particularly relative to the average firm out there. But we did support climate and environmental issues, political spending disclosure, social issues, et cetera, et cetera. So we really focus on the issues that are important to our clients. Next slide, please. And finally, this looks at First Affirmative's voting record for 2023 versus BlackRock. BlackRock is the largest asset manager in the world with trillions in assets under management. And you can see that from a proxy voting perspective, their record is abysmal relative to First Affirmative's. Again, this, in our view, is the impact of ownership. We take it very seriously, and we work directly with advisors and their clients to ensure that we're voting proxies in line with their values. So I think that's it, James, unless I'm mistaken.
Well, I think you've done an excellent job. I'll just kind of summarize that, not only is this a company that's looking at, balancing your values and getting you returns consistent with the returns that you need, and that's going to be part of the process thing that I'm going to talk about. But at the same time, knowing that, instead of you needing to be out there, advocating, picketing, et cetera, that they're going to be voting some things in the background, especially those that, do fit to this environmental, social, and governance, because from the prior slide, you could see that it appears, though, that boards seem to be more aligned and caring about executive compensation than they do about these social issues that matter to, well, at least me and the people that are on this webinar. Thanks, Theresa. I know that you have to run, and we will do the best that we can between Mike and me to answer any questions that come from the audience.
Excellent. Thank you.
So allow me to kind of step back a little bit from kind of the answer that Theresa was giving you as one of the answers, and talk about the way that Envision looks at investing. So we always believe that the best way to get the best results is to go through a financial planning exercise where we really go in depth and learn more about you and what you want to accomplish and actually begin to quantify that. So we want your risk and return, your investing, to be aligned with reaching your goal, which has to often do with how much money you can save and future cash flow that might be coming to you. So that's why we really like that. So now let's jump into, well, what do I mean by determining the investment recipe? Well, we first of all kind of have some idea that by mixing stocks and bonds, overall, we can start to get some different looking portfolios, like one that's, say, all cash. Even if you're not fully familiar with bonds, all cash is going to be a lot more, you know, like you'll see the same dollar amount pretty much every day. But if you get into stocks, depending upon the stocks, and some people don't like the roller coaster, that's on the other side, and how you mix them, we begin to get into some advanced portfolio design. I equate it with cooking because I love to eat. So what kind of recipes might we make? And I'll tell you today that even the recipe that the values aligned direct index solution has in terms of how it achieves its goals versus the one that we use with Ethic and use here in Envision and what I call my core models, those are actually two different recipes. And you get to decide, because we decided not to just give you one thing, you get to decide which recipes are right for you. And we call that whole thing risk-adjusted return enhanced, that approach. It's an acronym. It says RARE because I think it's rare that people are actually getting that. So you'll see, Mike knows I like to rhyme a lot. So that's kind of how we arrive at that. And then the next slide will kind of give you some idea, because I'm like, JB, you say a lot of stuff. So notice at the top, we see these words called capital preservation, balance, equity growth. Personally, I don't really care what the words say. I care about what do these mixes mean. So this actually comes from the financial planning software that we use. Notice that in the first one, that it's primarily bond and a little in some stock. But as you go down, you'll notice that the number goes to 100% stock. When we look over to the side, we notice that the returns increase as well. Well, some people might say, "Ooh, let's jump on the that return," but then I'm going to tell you to tap the brake for a moment, because there's something called standard deviation. It's giving you an idea of the ride that you might expect. So the capital preservation ride looks a little like this, and that equity growth ride looks more like this. Now, over time, we expect that your money is going to grow, but that's over time. And every time horizon isn't the same, and every need for taking risk isn't the same. But this was just trying to give you some idea when we talk about investment recipe, at least at the high level of blending stocks, bonds, and cash. So now let's move into the how we get to pick the ingredients inside. And I'll start with this slide to give you an idea that we look at both values research, your stake in this case, and financial performance research coming from Morningstar, which is located here in Chicago, and a worldwide firm. So to give you some idea, if you really like line charts and some numbers and tables in the back, don't really read this slide. It's just trying to give you an idea that this one is focused on the portfolio, which is what we were kind of giving you the idea in the prior slide on the recipe. But we also look at the individual fund level. So this gives you an idea that there's a lot for us to look at. So now I'm going to give you the two technical slides in the entire presentation, at least from my standpoint. They're the two most technical slides, but it's a walk into the process. So you've heard today this MSCI, ACWI. You might be more familiar with the S&P 500. there's lots of research companies out there who have different ways of looking at the investable universe of investing. I'm going to use some examples from Vanguard, where Vanguard actually takes some indices and then they turn them into portfolios. So target date retirement series, the life strategy asset allocation are just a couple of their choices, where they've actually taken these four mutual funds, which they've just transferred the exact or replicated the exact index that came from these companies, and then they vary the percentages based upon the recipe that they're trying to create. I'm also going to highlight today that because of regulatory issues, I'm unable to show you the exact returns of our portfolios in today's presentation. We'd love to show you those in the future. I kind of have to do that on a one-on-one basis, but I'm pretty confident that you'll see that we more than compare favorably to what we're going to show you. Many people have never heard of a thing called the MSCI KLD 400 Social Index. It was one of the first indexes that was about looking at the environmental, social, and governance aspects. This chart even shows you that over time, compared to the non-environmental, social, and government version that this got extracted from, that you actually would have made more money in this one compared to the other. I actually pulled this from MSCI's own website, and iShares actually does, which is a BlackRock company, actually converts that index into something you can actually invest in. So now I'm going to have Mike talk us through how your stake goes about what they do.
Excellent. Thank you so much for having me today, JB and team. My name is Mike Amoroso, and I am the Client Success Manager for Your Stake. And what I'd like to go over, if we can go to the next slide, one of the things that I do is I help financial advisors understand our platform and then communicate that information back to their clients. What we offer is we have over 140 to almost 150 metrics that we can analyze a portfolio. And just as JB was alluding, we can create, whether that's a bespoke value set for you, the individual client, or kind of a thematic approach around a particular cause area. One of the best kind of components, or what really differentiates us among other service providers that are out there, is that we rely on independently verified third-party information. So there's frameworks that are out there that'll send questionnaires to these companies. Then these companies answer those questionnaires back based off of the access of data that they may have available, the level of expertise that they have on their staff. And a lot of times you'll see a lot of what's called asset concentration, because companies that are large enough and have the expertise to fill out those questionnaires are often rated and then rated for inclusion into various different types of investment opportunities. What we do instead is we rely on this independently verified third-party information. We're looking at academic research. We're looking at government filings, non-government organizations, subject matter experts that are working in the field that's being analyzed on a company basis, and then we aggregate that information up so that it's in a concise report for the client relative to their portfolio. If you work with a financial advisor, you may often hear a financial advisor describing a benchmark. And what we're doing is a benchmark is like a workout buddy that's maybe in a little bit better shape than you. So you're always trying to beat that buddy. In your portfolio, you're always trying to beat that benchmark. That benchmark may be comprised of things that we're familiar with, like the S&P 500 or maybe the Bloomberg Ag. And what we want to do is we want to essentially beat that benchmark. And what we do in Your Stake is compare how a client's portfolio may perform similar to how we report on financial basis, but how the portfolio performs against that benchmark relative to the client's values. And we have the ability to create those value sets as you see here. Go to the next slide, please. So as kind of Theresa was alluding to earlier, we've taken these 140 some odd metrics that can be in and of themselves relatively unwieldy and organized them around kind of 8 different categories. So we've taken the metric and we've kind of looked at some similarities in what that metric is addressing and mapped it to some of these 8 categories. In addition to these categories here, we have the ability to map these metrics to perhaps a particular faith. So Baptist, Catholic values, Jewish, Sharia, all of those values. We take the metrics, read the guidance of those different denominations and faiths, and select from our value sets which ones match succinctly. Or we offer the ability to a financial advisor to provide clients with a questionnaire that'll allow them to create bespoke values to them individually. For the purpose of this presentation, I believe we're going to focus mostly on the racial equity component. So what's in our racial equity kind of value set there. So one of the areas that we're looking at, we're not just looking at kind of discrete components. When we consider inequalities, right? Inequality of itself is a symptom of centuries of systemic racism, right? And to address one component of racial inequality is really just address one particular symptom. What we're trying to do with a value set is have a thematic focus that addresses just that, the systemic nature of our financial system. I always tell clients that in a democracy, we vote once every 2 years. But in capitalism, we vote every single day, like that Visa acronym that JB had earlier, right? It's how we invest, how we spend, how we save, and what we do with the responsibility as investors that really, truly matters. So again, going back, focusing on that kind of that thematic approach, when we look at how we're going to evaluate a portfolio, what we really want to focus on is how to integrate that values component, that value integration in that funnel that JB had shown earlier. So we're looking at utilizing your values as another layer of due diligence, as another layer of selecting funds. It would hurt my feelings if I were to take a loss, but it would sting twice as hard if I were to take a loss around an area that I care about, for in particular, equality or racial equity, right? I'll give you an example of what I mean. So when we look at systemic racism and we consider maybe the impacts of redlining within our nation's history, more often, African-American communities are kind of coalesced around areas of pollution. We can look at areas along the Gulf Coast. In the Midwest, we can look at maybe auto manufacturing facilities or auto painting facilities and the proximity of predominantly African-American communities. So we should be mindful of that impact. We also know that the 13th Amendment simultaneously abolished slavery, but also made concessions to steal one's human capital if they're currently incarcerated. And there's many layers of that metric that we may want to kind of consider in a value set. What we try to look at is what is material to the investment itself. But what values-based investing says is that there's not kind of a hard line between what is considered traditionally financially material and what you, the investor, would consider material to your investments themselves. There is an emotional and a financial component to your values. And what we want to do is eliminate excess risk within that kind of space that you're not getting paid for. Your returns should be a function of the level of risk that you're willing to take. You should get paid for the risk that you're willing to take. So
I
what we
think,
try
Mike,
to do,
the next slide will
yeah, if we
help
could,
further embellish some of the points you're making by the comparison from that Vanguard to the iShares.
yeah. So on this report, we're looking at the iShares MSCI fund that JB had alluded to earlier, and we're comparing it against a Vanguard 2050. And we can see how this iShares ETF has performed better on a values component. And if we go back to that chart that JB had shown probably 5 or 6 slides earlier that showed that graph, not only would it have returned better on a financial perspective, but it would even perform better on a values perspective. And what that research that JB opened up the conversation tried to say from that professor at MIT is that essentially what you feel is probably shared by the market itself, and that is going to be reflected in that firm's ability to generate revenue. Can we go to the next slide? So for when we're talking about the prison industry, right, a lot of times we may want to go into a conversation with an advisor and say, I don't want any prison industry exposure, period, whatsoever. Now we've got to like take that kind of and slice it up a little bit. One, we may not want to, so as an analyst, right, if there was a company that utilized prison labor, I would have questions. Why do you need to subsidize the profitability of your good or service by stealing capital? And if you are stealing capital, where is the delta of labor savings cost going? Is it going to you, the CEO? Is it coming to me as a shareholder? I have questions about the success and health of your business model. But tied within prison industry exposure, you're also going to find companies that provide goods and services to the prison industry. For example, Microsoft. Just because a prison runs Windows, that doesn't necessarily mean that they may be involved in a nefarious activity or one that I morally object to. Conversely, you'll also see exposure to companies that provide telecommunications and mental health services to the currently incarcerated. I would argue there's some good baby in that bathwater, right? Like chances are someone may be currently incarcerated because of systemic racism. They weren't able to access maybe the mental health services that they needed. And now we certainly should provide them with access to mental health services. So what your stake allows you to do is not only rely on that independently verified information, but achieves targeted specificity, where you as the client can quantify your values and what that would mean in your portfolio. And advisors like JB can kind of dial that back and say, why don't we have no exposure to prison operators? Why don't we utilize our exposure to prison funders as an opportunity to engage and drive change? And why don't we continue to invest in those companies that may provide services that we believe are fundamental human rights to those companies? So you can achieve greater specificity while at the same time get paid for the risk you're willing to take.
Well, you can all hear the passion that Mike has for the topic as well as the knowledge. So thank you for dropping that on us. Let me, because we're trying to build up too for Morgan, so she kind of gets to that cleanup here. So again, explaining more about the options, but so now I'm going to get into what I call Envision Justice, and it has a couple of executions. So this just again gives you how it works. We work with Charles Schwab, but in this case, it's fully developed at Envision. So we have 2 versions of this, and it kind of comes from based upon the invested amount. You would actually go through mutual funds, and that's the middle column, or as we call it, powered by Ethic, which now you get even more specificity than you otherwise would have been able to have. We have a systematic structure. So if you remember the chart that I gave you from Money Guide Pro, we actually do have a structure across the continuum that would include, again, stocks and bonds designed to match to your needs. And now we're going to basically say, look, the slide looks the same, except in this case, it is with Epic. So with no further ado, let's hear from Morgan.
Hi, everyone. It's great to be spending time with you all today and excited to share some insight on how we have partnered with advisors like James to create a really unique, bespoke solution. And for the purpose of today's call, we'll really focus on what we're doing around racial justice investing. So just at a high level, to give some context on how we operate, very similarly to First Affirmative and in those first few slides, we're also what's called a direct indexing provider. So what we're doing is we're starting off with a benchmark or an index and really unwrapping it and hand selecting specific companies based on how they're performing along the lines of the issue areas being prioritized by the client within their portfolio. So for example, if we have a benchmark universe that starts off with, let's say, 4,500 different names, we're then going to define the client sustainability preferences and run an analysis against that benchmark to identify how many of those companies, how many of those 4,500 companies are actually deemed clean or investable based on the client sustainability preferences. So as an example here, you'll see that that leaves an investable universe of about 2,200 companies. We're then going to use a portfolio optimization tool called MSCI Barra that's going to go in and say, okay, which subset of those 2,200 clean names are actually going to be included in the Ethic portfolio in a way that's going to mimic the financial profile of the overall benchmark in order for us to get as close as possible to the look and feel of the benchmark as relates to financial performance. So we end up with an optimized portfolio that comprises, anywhere between 200 to 300 clean names. Next slide, please. All right, so today we're going to be talking through the white labeled firm branded strategy that we worked with James to create specifically for Envision Wealth clients. So we created the Envision Wealth core value strategy that includes our climate change, racial justice, and women's rights pillars. And for today's purpose, we're obviously going to focus specifically on that racial justice pillar and talk about what are the components within it and how do we actually measure and report on the impact metrics. So as it relates to the racial justice pillar, we think about all of these issue areas very holistically, similarly to your stake, as Michael was able to showcase earlier. But we're really not just looking at things like workplace diversity and working conditions, but we're also looking at things like greenhouse gas emissions because of the fact that vulnerable communities are significantly more impacted by greenhouse gas emissions, including communities of color. We're also taking a look at things like exploitative products, product quality and safety, etc. Next slide, please. So for the next few slides, we're actually going to look at, what are some examples of companies that end up being divested from this particular portfolio that we have created for Envision Wealth. So as it relates to diversity policies and practices, very important consideration when it comes to racial justice. We're going to see companies like, Berkshire Hathaway and Costco being screened out of the portfolio specifically around their diversity policies and practices. So we want to go in and identify, how committed is a company to diversity, equity, and inclusion, and therefore get a handle on whether or not they should be in the portfolio. Next slide. Another extremely important consideration as it relates to our racial justice pillar is, the work that we're doing around prisons and border detention divestment. So we work with a data provider called American Friends Service Committee, and what they are hyper focused on is the private prison industry. and really calling out any company that's involved in the private prison industry in any way, shape, or form, whether that's direct financing or owning of a private prison, or if a company is using private prison labor in their supply chain, as well as if they supply private prisons with any type of goods or services, whether that be transportation, food, telecommunications, uniforms, etc. So some of the companies that we see here that are being flagged for this as well is like Costco and Walmart, for example, which both use private prison labor in their supply chain. Next slide. Okay, so another really important consideration is predatory lending revenue. So what you're seeing here, and this is the way that we visualize and quantify the impact that is being had within the ethic portfolio as it relates to different racial justice considerations. Here, the example you're seeing is predatory lending revenue. So this is essentially telling you, had we been tracking to the overall benchmark, which the benchmark that we identified for this strategy specifically is a combination of both US and international companies. So this is telling you if we were tracking to the overall benchmark without any type of racial justice consideration, that would represent a predatory lending revenue of $15.4 billion versus $0 in the ethic portfolio. So why is this particularly relevant? You can see a short description that says that in the years leading up to the global financial crisis of 2008, loan originators in the US gave Black and Latino borrowers riskier, higher cost loans than they did similarly situated white borrowers. Again, to help to frame out why this is a really important consideration when thinking about including racial justice into your investment portfolio. Next slide. All right, so now we get into some of these more environmentally related considerations. Why is something like wastewater particular to racial justice and Black and brown communities? So you can see again, in the US, minority communities bear disproportionate health risks as a result of disparities in access to safe and reliable drinking water. So we want to scrutinize companies that are polluting water sources in or around Black and brown communities. So again, this is what we're seeing here is a wastewater ownership comparison, which is showing you, had we been tracking to that overall benchmark, that will represent a wastewater ownership of 492 metric cubes versus 17 metric cubes in the ethic portfolio. What does that difference in 475 metric cubes look like? It's about 11 tanker trucks of wastewater / sewage. So again, a very visual way to quantify the impact that the portfolio is having. Next slide, and I think it's the last slide, so it should be perfect timing. Another ownership comparison here, particular to hazardous waste. Again, we can see here Black Americans are more likely than others to live within a mile of a polluting industrial facility. Once again, why hazardous waste has to be a consideration if we're thinking of incorporating racial justice in an investment portfolio. So hazardous waste ownership comparison, this is saying in the overall benchmark that represents a hazardous waste ownership of 3,186 kilograms versus 60 kilograms in the ethic portfolio. So a significant decrease in that hazardous waste ownership. And again, what does that difference in 3,200 kilograms look like? It's about 1,500 people's daily waste and 594 household trash bags. Again, wanting to empower the investor to know, what it is that they own and how we're showing them the impact that they're having through using a solution like ethics. And I think that was the last slide, but happy to take any questions if helpful.
Thank you, Morgan. I know that people are going to be excited to read your disclosures, but I was thinking that, I have actually lived in Flint, Michigan, so that became the poster child for water. And I am originally raised in Gary, Indiana, where the federal government had to come in and address the polluting water that was killing all the fish in Lake Michigan. So I believe that I was raised in primarily Black and brown communities. So I feel like, I'm living what your slide is saying.
Exactly.
So we're about done, but what we always like to do is provide for information to action. So you've seen a lot, but can you retire without investing money in discriminatory companies? I hope you say the answer is yes, but you're wondering how might you do that? So thanks to Mike's company, they've got a wonderful thing which allows us to do a portfolio check. So we use the same Vanguard Target Retirement with the iShares, and you'll see that when it comes to values alignment, one just simply does a lot better than the other. I'm sure you would know what it is. When it comes to returns, because here we can actually show you returns. Oh boy, the returns, and it also showed it on that one chart I showed you earlier when we compared the KLD against the index itself. Now we're actually comparing it against something in particular, this Vanguard Target Retirement, and you'll see that in all periods, it's actually doing better. And, you know, so we have fair and equal. It's going to be a little bit more volatile than the Vanguard Target Retirement Series. Well, actually, technically, I put in the Target Retirement Series, which actually has about 20% bonds or so in it. So I would expect the volatility of the MSCI to be higher. But I do know that a lot of people got defaulted into a Vanguard Target Retirement Series. So no matter which one you're in all of the sub funds that I showed you earlier. The percentage of bond will be the one that's going to change amongst them all. But I wanted to just simply give you a quick, so it's not necessarily the case that there would be more volatility if I actually did a perfect comparison. Well, here, this has been for information today. So if you'd like to get a portfolio checkup on your own portfolio, it could be something that is an IRA, an inherited IRA, a Roth, etc. We could even run one using your workplace plan. Our ability to affect your workplace plan won't be the same, but we can still run it for you anyway. So you can either take a picture of the QR code, or you can decide that you're going to email OPS at envisionwealth.us, OPS at envisionwealth.us. Any Q&A out there for us?
Yes, so I will jump in here very quickly because I know we're about to run out of time. I just want to remind everybody, thank you so much for coming to Envision Money Making Sense. Thank you to our wonderful panelists. This is part one of a three-part series where we're sort of really digging into specific values-based investing. If you register, you will get a recording of this regardless if you attended or not. If you didn't attend, we missed you. Please join us next month, the third Thursday of March. I don't remember the date off the top of my head. And as long as you register, you'll get the recordings, you'll get the reminders. Again, we do this every month. Envision Money Making Sense. Thank you again, everybody who
Which next month is Women's Empowerment.
Women's Empowerment. Yes, sir. Okay, so we probably have time for one question. So this was the first one. Is it realistic to break down every part of my investments in order to be socially and ethically conscious? I'm not sure who wants to take it.
Realistic, that's an interesting word. Hey, Mike, why don't you give a stab?
I was just going to say that sounds like a financial advisor question. Okay, so is it realistic? Yes and no. Where it's maybe not realistic is like looking at maybe a municipal bond or a government treasury. That's an investment that it is what it is. Whatever that government is going to do or whatever that bond's use of proceeds would go towards. Certainly for your equity allocation. Now, I would caution against chasing impact within your once you understand how you're invested. More accurately, I would say I select maybe one or two cause areas at a time that you're going to target for engagement, maybe one or two that you're just not going to participate in whatsoever. But it's always good to know how you're invested because as an equity owner, right, you're an owner. You have a responsibility. If you have a dog and your dog bites the neighbor, you are responsible for the dog biting your neighbor, right? It's about what you need to do as the investor, as the equity owner.
Because I really like this slide, Morgan, one might be able to see that the grayed out areas of climate change and women's rights, but in many cases, some of these focus areas are already included in another pillar. And that potentially, as one might say, I'm going to add more things because I was thinking of Mike's comment about, I'm adding and adding. So there can be a point, at least that I have kind of experienced, that when you have so many pillars, you may not actually be getting any additive. So I don't know if you want to talk more about how the focus areas might relate to that result.
Yeah, definitely. And I know we're a little bit over, so I'll keep it at a minute or less. But essentially, the way that we think about it is, there's 1,000 different terms that you could use to describe what it is that we do. Some people call it ESG, some people call it impact, SRI, etc. We prefer to break away from the noise and say we're really just focusing on full information investing. We want to empower you as the investor to know what it is that you own and have a much deeper understanding of how a company is behaving based on the issue areas that you care most about, whether that be racial justice, climate change, or something else. So in that lens, operating in this like personalized structure and divestment structure, we're able to weed out the worst actors within the benchmark based on what it is that you want to prioritize. That being said, we don't just stop there. We're not going to say, okay, we weeded out the bad actors. We can kind of just like set it and forget it and move on. No, because we want to continue to push the companies, even that are deemed clean enough to be in your portfolio, they could still be doing better in a lot of areas. So what we do is we vote on proxies on behalf of every ethic client or everybody that has an ethic portfolio in order to continue to push even the cleaner companies to do better based on the issue areas that you chose to prioritize. So that being said, we use a company called Institutional Shareholder Services. They have what's called a socially responsible investing guideline that we use to vote on proxies on behalf of clients. So for example, if Apple is having a proposal on whether or not they should report on racial/gender pay gaps, we're always going to vote for that because we want to push Apple that may be in your ethic portfolio to continue to do better on all of the issue areas that you care about most.
Well, thanks for that additional info. I'll just add a little bit that from another conversation and webinar that Costco has been made aware of some of their private prison involvements. My understanding through this proxy voting that we've heard about today, and that their intention is to, by the end of this year, be out. So that's what I've heard. I love that Morgan said we keep on trying to push people, and yes, we eventually will find out if they're really out. So I like to thank Theresa in her absence. Thank Mike, thank Morgan for being here today, and hope that we will see or hear from our listeners that they will be with us for next month, where we'll dive into this topic on the women's empowerment side of things. Thanks again.
For the questions that were not unfortunately answered today, we will send a follow-up out answering them. Made sure to write them down. Thank you again, everyone. Thank you, James, for hosting and bringing us in together. And we will see you all next month.
My pleasure. Thank you.
All right.
Thank you.